Hello, ladies and gentlemen, and welcome back. Well, we've just seen the core inflation numbers come out for the US, and look, let's face it, they were not good. Regardless, though, the markets bounced off the 3,500 zone after opening with a massive switch that was around 3 and a bit% on some of the indices. We've now seen a ramp that is like no other. We've only had a few of these over the history of the stock market, and in today's video, we'll be looking at some of the previous ones and to see what actually has happened off these 52-week lows. But regardless, there is a lot of opportunity now in markets, and while it may seem like you've missed the boat, there's actually a lot going on under the hood in other markets other than just stocks, which we will be covering today. So with bad numbers supposedly being good for the market, is this actually a turning point, or is it more just a squeeze that's going to be pushed later? Probably that one is more likely. 5% is now the possible expectation for April 2023 yields in America. It's getting pretty dangerous out there, guys, and you can see that we're in that incredibly volatile time. This is where things get serious. Well, welcome back everybody to the Daily Show, where we discuss markets around the world. And of course, today we'll be looking through the inflation numbers. We'll also be covering off the big data points that we've seen recently, the key levels, the lead indicators, and all of the charts that you could probably be wanting to look at right now. Let's talk about Sp500 largest reversals and NASDAQ largest reversals from the 52-week low. Well, we've just entered a very serious reversal. That was a pump like no other. As you can see here, there are very few times in history where we've seen markets open so negative and then move to such a big positive after a 52-week low. Notice that we're in the illustrious territory of the global financial crisis with the S&P 500, and the swing was even more wild when you consider the NASDAQ, basically over 5% from the low to the high. This means that we're now in a point where squeezes could happen. The market could actually ramp, even though it may not make sense. And what I want to do is show you some of the previous times we've seen this on the S&P 500. So these are some of the points. This is one of the points here in January of 08. And you can see that candle that came through. It looks very, very similar to the type of candle that we have now, which we'll look at very, very soon. Then we have the similarity with just before the really horror show watershed moment of the global financial crisis. In fact, we had two reads in here, but this is the one I wanted to look at. So we actually saw another bullish day after this, and then a sell-off that led on to that watershed moment, a significant, massive drop that happened after that. And if you've been following our videos, this is still a distinct possibility even after such a huge ramp day. This is not the day to feel FOMO. It's the day to practice patience, to look for the highest kind of quality trades, and to always remember there's another opportunity, especially if you're a trader and not an investor, around somewhere else. Here's the one from 2011. You can see this one actually did make a new low, and then that was the end. And you could notice here that there was a lot of thrust that came after this, consecutive bullish, 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 bullish. And at the time of recording, we do have a market that's moving up in the futures action. So when we take ourselves to where we are right now, and we just have a quick look here, you'll notice that there's that big ramp candle, and it came with a decent wick down below. We've got a gap that could fill here at 37.44. We'll cover this later. And we've got a whole bunch of different little pullback levels that could be met by small miniature demand, at least temporarily. There's also some amazing squeeze levels moving forward if the markets do start to ramp. So opportunity is going to be around the corner on markets such as this. Let's talk about inflation though, because of course this was what everyone was discussing. We saw here basically the inflation number rose a little bit more than expected. It was expected to be about 0.4%. We ended up getting 0.6%. And what was most notable about it was things like food continued to be sticky. You can see here on this chart that we have the overall food kind of broken down, and it still looks very, very worrying on the surface. If we look at where all of the inflation has been recently, it's been in airfares, it's been in household energy, another very sticky one on the report if you've had a look at it. Food at home's been horrible, transportation, and we're also seeing things like medical expenses as well start to ramp up. So we ended up getting an overall inflation reading of 8.2. The expectation was 8.1. when you look under the surface, most of the drops in inflation were through fuel, energy, the ones that you would have expected, which is why quite a few people were expecting the inflation number to come in a little bit under expectations, but it just didn't. It's still sticky, and this leads us into things like the CCP meeting this weekend on the 16th becoming even more important, because if they don't, let's say, move their policy and they continue to do lockdowns, what's that going to do to things like inflation? Is it going to hurt the supply chain again? There's a lot of uncertainty in this market, so be careful out there, guys. All right, let's talk about similarities with previous negative 20% years. So as you can see here, we're basically in the kind of line of average declines actually here. Here's the average, here's where the market was, and of course it's now done this little bounce up. So it's basically at that point where previous times the markets have turned around. Let's have a look now at all of the previous main kind of times that we've seen this occur. 2001, we all know what happened there. This was actually near that bottoming period. 2007, the one that's most closely correlated right now, we were close to the watershed moment that led to really significant further declines. And then in things like 1973, we were close to the low. 1965, we were basically at the low. And 1961, again, we were at the low. So if we're taking a look at all of this data in purpose, unless it's the GFC or something similar to that, this was actually a turning point in markets. And it makes sense when you look at some of these data points coming up. Let's also discuss some other reads we've got here. So this is just the read about those since 1952. What happened there, of course, is the global financial crisis. You can see that watershed moment led on, and the lows from every other data point. So statistically, yes, most of the time we'd seen bullish turnaround throughout these next weeks and months, but time will tell. We're going to need to break some pretty serious levels. Remember, this is inflation. This is a totally different scenario. We're just using these data points to get a little bit more information about what is possible. Now, when the Sp500 had 6 consecutive losses at a 52-week low in a bear market, again, we tended to see like near the lows, but as you'll notice here, in over 3 of these data points, we weren't at the low yet. We actually had the watershed moment here in global financial crisis. We had a significant decline here in the 70s and in the 60s as well, significant decline. Many more percentage points to come. Notice the stats over the next couple of months, very negative in this occurrence. If we go over here to when we have over a 2% gap down, again, after the 52-week low, there's that correlation. You can really see the global financial crisis. You can also see that we were sometimes at lows through these reads. So this is why it's so difficult, because if we do end up making a new low underneath this low that we've just put in at 3,500, that could really signify that full fear coming through. Maybe it happens after the CCP meeting if they don't switch. Maybe it's another data point in the future. Here's the same kind of data point here, but now it's only 1% down, open, close. We've used this one before in 2020 and 2022. And again, the reads here for the next couple of days have generally been positive, followed by more of a coin flip or negative situation about a week or two later. So that's, again, pointing to maybe a little bit of a ramp here, a bit of a squeeze, and potentially turnaround. These are the two main kind of seasonal approaches. If you were in any other year, midterm election years tend to really turn here at this point, and usually September into October is negative with that November turn. We're now at the time of this recording in the middle of October, so it shows us that, you know, the turn really should be happening if it's going to. Here's all of the bear markets and recoveries for the last 200 years if you wish to pause the video. And do remember, we've kicked off earnings season. So this could be another catalyst both ways in the market as well. You know, what's going to happen with the banks on Friday? This is what we're ahead of. Citi, Wells Fargo, JP Morgan, Morgan Stanley. They're all coming out with their reports. Will they show strength or negativity? And even do we want them to show strength in a point where the Federal Reserve has realistically been forced now to potentially raise rates at an extreme rate, and we'll talk about that very soon. So before we jump into the charts and we take a look at all the key levels we need to be watching, I want to say a big thank you to today's sponsor of the video, which is Tiger Brokers. Now, we live in a time here of insane news, so you want to have a news feed. Ideally, you use something like Tiger Brokers to be able to get feeds like this, to be able to have those kind of premium services. The Wall Street Journal here, Reuters, Bloomberg, all of the big ones all in a feed headline here. And a lot of these are the premium versions as well. So Tiger Brokers gives you that for being, of course, a client of their brokerage firm. Now, we are also in earnings season, and it is one of those times where you need to be aware of the stocks that you are in and whether they're going to have earnings. If you're interested in dividends, you can put that on. I personally love the weekly and monthly view grids so you can see everything and you can select the market you're interested in. Let's say you're not interested in any market but the US, you can select that. You can add your watch list in there as well. So that means that you can just look at the stocks you're in or even select position, which I really like. Being able to select these things is fantastic because it means that you can eliminate all the rubbish and just the things in your watch list or that you're actually trading at the time will come up in the earnings calendar. It's a great tool, and I definitely suggest that you consider checking out Tiger Brokers. Do remember, for any of the Australian and New Zealand audience, there's a special offer right now, 40 zip free stock and a whole bunch of other little extras if you fund the account with as little as 1 cent. But don't worry, for other members around the world, you can, of course, check out their links in the description, and there's a whole bunch of other opening bonuses. Thanks so much, guys. We'll see you now in the charts. So let's now jump into the charts and talk about what's going on. Now, a lot of you would have expected the VIX to jump significantly. We have expected that the VIX would hit like a 40 or a 45 like high when we're seeing the real capitulation of the market. Now, there was no real excuses for the VIX not to jump in the previous session, but I noticed that even though the stock market had opened down, the VIX was actually dropping through that session. Did the VIX precursor that the market was actually turned around? Well, I guess it did. It came off that 35. It's still a very high VIX reading, but we saw it drop through the session because, of course, the stock market went up. I was kind of hoping that the VIX would come out with a 40 or a 45 read to show us that fear capitulation had come in. That's not what's happened here in 2022. The VIX is very strange beast. Remember, previous history, if you haven't watched these videos, usually shows that the VIX spikes to an extreme level where we fear or have a capitulation in the markets, and that tends to mark near or close to the bottoms in markets overall. So why did markets go up? Well, I think it's mostly a squeeze style situation. Potentially markets have oversold even for this figure. Look, you can make a lot of different cases for it. Let's just call it this way though. It's doing the exact opposite of what people would think logically. And that's what markets often do. The price action's bullish at this stage. And of course, most people are going to be trying to sell into that strength yesterday. Hopefully no one got too badly beaten in that. Practice risk management whenever possible, guys. Let's look at the yields though, because this is where things got wild. And I posted on our Twitter at FX Evolution about this. 5% is now the expectation in April 2023. But look at the 2-year. The 2-year spiked to 4.4%. That's getting close to those 2006, 2007 highs. So we're approaching what I've always thought would be the breaking point for the US economy and worldwide economies, around 5 to 5.5%. If we have to push to 5.5 on yields, I'm really worried about the economies overall. I mean, you can already definitely say you'll be worried about debt, but this thing's pushing a 4.43. Let's have a look at the forward yield curves. So we'll take a look here at December. The spike now at 4.22, expecting quite a few rate hikes coming through. Let's have a look at April 2023. We almost tapped 5%, now 4.89. Look at that trajectory. Wild stuff, 4.89. September of 2023, 4.79. So basically, most likely, rate hike, very little cut. How these yield curves have changed over the last couple of weeks has been big. Then we have one rate cut expected by December of 2023 by the market. So it kind of goes like this, sits there for a while, one rate cut, and then sits there for ages. And I mean ages. Remember, the 2-year is expected to be at 4.5-ish%, 4.4. So that's basically saying that we're going to get one rate cut and then we're going to sit there for a long time. Can you imagine the pain that this is going to put on so many zombie businesses out there? There really could be more to come in these markets moving forward. But let's talk about the current market. Well, the dollar index reacted very interestingly, and it was probably the one that's giving us the most interesting kind of levels. So here's the dollar index, and you can see before the news event, it dropped down. It didn't quite get down to our demand level. We'll talk about that soon. But then it bounced to a new high and took that supply. So this is the supply we've had here for quite a while. It actually took the high and then swung it and instantly started reversing. And this was a day that took a lot of stop losses out. It took supplies, it took resistances, it took everything across the markets. And as we look at all of these stocks, you'll see why. Then we basically belted down and we moved underneath this level. Now we still have this area